So, this is petty cash, and the first question we always have to look at is, why do we need to learn this? And obviously, it's going to be on the test. Also, if you are hired at a business, and chances are that one of the first things that you get to do is to run the petty cash account. I've had students in my classes who that has definitely been the case, and they know all about this already, and so they're interested to see how the accounting goes. Okay, so petty cash journal entries, there's really only 3, and they're really very easy, but it's amazing how many students mess them up. I'll show you a 3-step process for doing them that you'll get them right every time, if you do them my way, but you know, that's up to you. Okay, so let's see. Why do we have a petty cash fund? You know, now that we know why we have to learn this, why do companies have them? It's mostly for small incidental payments. With the main checkbook, payments are supposed to go through a voucher system of approvals before you write a check. These would be situations where an employee forgets his lunch and just needs $10, or people are working on a project and all of a sudden they realize that they've run out of something crucial and they have to run get it. They need $40, or maybe something arrives COD and they, expect a cash payment on it. The pizza's here, So you have a petty cash fund for what they call incidental expenses that you really don't want to take the time and energy to put through the main checkbook, but you still got to keep track of them. Okay, so what does it look like? It might be a small drawer, a box. Supposedly it should be locked. If you go apply the internal control principles to petty cash, you'll find things like that. You'll have one petty cash custodian who's responsible for the petty cash fund, so if things go missing, they know who to blame. You've got this, petty cash box. So how does the cash get into the box? You get a check from the main checking account, go to the bank, cash it, put the cash in the box. Cash is in the petty cash box. So say we put $100 in. Then during the month, what happens is the employees come in and they say, oh, I forgot my lunch. And so you'll give the employee $10. The employee will give a receipt that says I owe you, for lunch with, the employee, just an IOU. The people who need the office supplies working on the emergency project, they'll come running back in and they've got their supplies. They give the petty cash custodian the receipt and the remaining cash for whatever they were given. FedEx delivers the package COD. Cash goes out to the FedEx guy, the FedEx receipt comes into the box. So at the end of the month, you're left with less than $100 in the petty cash box, but you're left with all the receipts that tell where that money went. Now that's all very nice, but the books, the company books, don't know where all that money went, and so the purpose of our petty cash journal entries, part of that is to tell the books about what's happened here. So let's just kind of go through these. So we set up the petty cash fund for $100. So it's the 1st of September. Okay, we can do this. And the account title would be petty cash because we're setting up our petty cash fund. The debit would be for $100. And where did the money come from? Well, it came out of our main checking account. So that would just be cash, 100. That's the first journal entry, not too bad. Okay, so the slightly confusing one, and this is where my 3-step process comes in, is at the end of the month, we have to tell the company books where all the money went. We've got $75 here that we need to account for. So we do this in the language of accounting through a journal entry, and we're going to use the accounts. So where did these go? Well, $40 was for office supplies, so we'd just debit the office supplies account. And here, when we're going to be using regular accounts, so we probably don't have an account called IOU from employee, we might more properly call it due from employee. Okay, so we're not going to have just, we have to have proper account names here. FedEx receipt, that probably, we don't have an account for that. That might be sort of delivery expense. So this goes to the, proper accounts. Okay, so it was the 40 for the office supplies, $10 for lunch, and 25 delivery expense. And then, so those are what we have accounted for there. To replenish the fund, it says the cash remaining at the end of the month was $25. Okay? So when we're doing this, we say how much cash, and this is where you don't just add up the debits. You have to say how much cash do we need to get it back up to the original $100. Well, 100 minus 25, we need $75. Then we check to say, okay, so have we accounted for where all the money went? 40, 50, 60, yeah, we have, it works. Okay, so that's your basic petty cash setup. You set up the account, petty cash account. You notice that when you're replenishing it, it is the main checking account that gets credited because you're going back to the bank to get more cash to put back into the petty cash drawer or box or whatever. So when you're doing this journal to replenish, it's a good idea to sort of think about the cash one separately from the receipt one. I usually do the cash one first and say, okay, we need $75, and then you do the receipts that you've got. If it adds up, you're all set. But what if you only had $20 cash left instead of 25? Say this was only 20. Then, when you went to do this journal entry, doesn't erase well, you would say, oh, there's only $20 left. We got to get 80 to replenish it. But now, does your journal entry add up? No, it does not. In other words, you can't account for $5 of this. So we have to add another account here, and that account is cash over and short. So for 5, and that could be a debit or a credit depending on whether you're over or short. So now we go 25, 35, 40, 80. Okay, so that adds up. Cash over and short is a control account, and it will, as long as it's not a huge amount, you're probably not going to worry about it. But if your cash over and short was a significant, part of the amount of the fund, you'd probably want to take a look at it and see what was going on. Over and short can happen because change was made improperly. It could happen because somebody forgot to put in a receipt. It could happen because someone's stealing money from the petty cash fund. So that's how that works. So then the next question we have is, say on October 1st, you wanted to increase the petty cash fund to 150. Well, right now, it's got 100 in it. We want to get it to 150. So to increase it, we would simply go petty cash, and we go, get $50 more from the main checking account and put it in there. So if you're posting these to ledger accounts, your petty cash account would now have 150 in it. And so next month, when you go to replenish the petty cash account, you'd be trying to get it up to 150 instead of 100, okay? So that's your petty cash. There's a couple of petty cash examples that follow, and they have sort of detailed explanations, and I'd say take a look at them, and then if you need more explanation, let me know.